Welcome to 100 Units. I'm excited to have Jerry Mandel. We met actually like a decade ago when he was investing here in Central Florida. He has invested in real estate all over the world and has just written a new book. Really excited to have it here. Complete Guide to Real Estate Investing and Sponsorship. Jerry, great to have you on.
It's good to see you again, Joe. Great to be here with you.
Awesome. Jerry, give a quick introduction.
So, as Joe said, by the way, in 2008, when I saw the big crisis of the subprime in the US, I was never a real estate investor before, but I decided that probably it's a good crisis to look into it and take advantage of it. And in 2009, I talked to a few friends and I decided to raise some money. I raised like $1 million and I flew to Florida to look for some deals. And then I met you, Joe. Actually, over the next decade, between 2009 and 2019, I made quite a few deals, both buying individual units, but then also some multifamilies where you were actually one of my key contacts and deal flow generators. So here I am.
Awesome. Jerry, tell us quickly about your experience here in Florida investing and when you got into it.
Okay, so basically, as I just told you, in 2009, I was looking at the financial markets world falling apart. All the stock prices went down. Before turning into a real estate investor, I used to be an investment banker in Wall Street. I worked for Merrill Lynch for 10 years. But at that time, I was no longer working for Merrill Lynch, so I decided that this is a crisis that I need to see if I can find some good opportunities. And I decided to look into US real estate and specifically into Florida. I can say that before jumping into the Florida market, I researched all of the states in the US. Basically, at that time, REOs was a key word. A lot of real estate owned properties, and banks used to have a lot of listings of REOs. And what I did, I looked at the few states that at that time had the bigger lists of all, and it was Arizona, Texas, California, and Florida. Florida is East Coast. I have some family. I flew many times to Florida. I decided that I'm going to focus on Florida. And by the way, one of the tips that I give in the book is that if you are a relatively let's say, with limited capital, you need to focus on a single market. So when I focused in Florida, Florida is big enough market that I can invest in Broward County, Orange County, which is like, Miami, Fort Lauderdale, Orlando, Tampa. I don't need to fly to Atlanta, Georgia in order to find other deals or, Las Vegas. So basically, one of the tips that I had at the time was focus on a market that you can master and gain experience in and gain the contacts and the network and the deal flow and then the key professionals that I work with. So overall, I met you at that time when I started my fund. I started actually in south of Florida, and at some point I was very picky on the things that I invest. Then I decided that I'm going to focus on six communities that turned into that went through a condo conversion. And at some point, I actually raised more capital, and I realized that I need to expand my target market. So I actually started investing in Orlando as well. And overall, I found the Orlando market very attractive because it actually still offered much better investment opportunities than the South Florida market at that time. That's when I met you. And then I started buying individual condos for a few years. And later, when and I can talk later about, I did overall 5 small funds, real estate funds in the US. So in my third fund, I already started buying small, medium-sized multifamilies between 14 units. I think the smallest one was 14 units, and the biggest one was 64 units, in addition to buying individual condos.
What was the transition between the individual condos and the multifamily? What prompted that?
I think, and this is actually one of the things that I'm talking in the book, and probably a lot of people like to hear, is that when you make an investment as an individual, and many actually friends and then later investors ask me, should I buy my own property or should I join your group and be part of a bigger group that I don't own it directly, but I actually share exposure to maybe more units or bigger deals, okay? So at the time, the transition is what I'm talking in the book is that if you like to invest in real estate, why don't you become a sponsor? If you become a sponsor, turn your passion about doing a deal for your own property and turn it into a business where you can, attract other people's money, invest your own money, and suddenly you have more capital. More capital allows you to invest in larger deals. Larger deals typically offer economies of scale. You can share the cost, the fixed cost over a larger number of units or a number of investments. If you have more capital, you can invest in multiple properties and then you reduce your exposure to a single investment. So basically, I think when you are able to attract more capital is when you want to do bigger deals. Okay, bigger deals a lot of times can translate into more potential upside, more economies of scale, and actually allow you to charge money for your services. So when I build a fund or when I am doing my business, I actually structure it as a private equity fund, although it's a small scale, but I'm able to charge management fees and performance fees. Performance fees is a promote that if I am able to make money for the investors, I charge 20% of the upside. And suddenly it becomes a good business. So I say, if you like to make real estate investments, you have, let's say, X hundred thousands or X millions of dollars. Why don't you do 5 times more by attracting additional capital and do either 5 deals or 3 bigger deals, etc., and make money out of it? It's a better use of your time, better use of your capital, and typically, if you do well, you have a long-term business model.
And did you originally structure it as funds, or were you buying individual properties for individual investments?
So I think probably because I come from the world of institutional investors, I come from, I used to work for Merrill Lynch as an investment banker. I started this from day one thinking institutionally. So I decided that I'm not going to buy individual properties, but I'm going to create a pool. It's more difficult to do it on the first time, but it's easier to do it on the second and third time. Okay, so first time that you want to raise capital, it's challenging. But if you're able to go over this hurdle, you're gonna, and you do good business, of course. This is the key. You have to make good investments returns. But if you're able to do this, then you have a good business. When I started, for me, I said, listen, I had X amount of money available for investing, and remember that we're talking about 2008, 2009. Almost everybody who had some cash invested in the stock market probably was down 50%. So cash was a resource that was limited at the time, okay? So to raise capital was quite difficult. And I decided that I need to raise at least $1 million, $1 million to make this a worthwhile experience for me, okay? Because I thought that if I will invest my own money, which was also limited at the time, I'm going to buy 1, 2, 3, 5 condos. It's not a business, but if I can raise 1 million, I believed that if I do well in the beginning, I will be able to grow my fund, even the first fund, during the first 12 months. And I actually grew it from 1 million to 4 million. So my first fund was called GC Residential Properties. It was for a total of $4 million of equity. At the time was zero debt. So the first fund was 100% equity throughout the entire life of the fund. the second fund, and then I did the third fund, the fourth fund, and I did also one. Probably you remember that I invested in a mini self-storage business in Cocoa, and that was a single property vehicle. So overall, I think you have to, if you want to do this, let's say, if it's your first time ever, real estate investment could be challenging. But if you already did one or two deals for your own, and you can show very interesting track record, then I would strongly recommend that the next time you try to do, structure it as a fund. And even a small fund can work, because my fund was, the first, I started with 1 million, turning into 4. Actually made a lot of money for my investors, also for me, but if you're doing good, you create your second fund, third fund. In 2019, which is my next stage, I decided to gradually sell everything I had at the time in Florida. So it wasn't a fire sale, but it was a strategic decision to sell when I get a good price. And I sold everything, I think, by 2020, 21, something like that, or 19, 20. But in 2016, I created a fund for real estate investing in Spain. And in Spain, the most, let's say, efficient tax structure that I found was to create a REIT structure. It's a REIT like in the US. It has some REIT policies and obligations. I have to pay dividends, but I also need to list the company on the stock exchange. So it has more complexities, but still in this fund, I raised 28 overall, like 3 times, but overall like 28.4 million euros, which also is relatively small, but for me it was big, and it's a very nice business. Okay, so overall, I think later I will show you, like there's a page that shows exactly my 5 sponsorship businesses that I created and managed in the US at the time, and they weren't big funds. I think it's something that an individual person can decide that if he does a good investment in his first or second deal, why not try to do something a little bit bigger? It doesn't need to be neither Blackstone or one of the KKR's big guys. That this is a totally different market, but still you can find good deals. And Joe, I'm sure you and I follow your good deal flow that you have on your website. Interesting cap rates, and I think that even if it seems a little bit big for an individual person, talk to a few friends, raise the capital, structure the deal, take the financing, and do it, and then do the next one, and it can work well.
Coming from the institutional background, you chose, though, to go with smaller investments that an institution would never touch. And what was the rationale behind that?
Yeah, I remember, and this is something that I decided to do in Florida. By the way, I also did it in the US, in Spain. Okay, but basically, I looked at the market and I saw what is exactly my competitive advantage, because I'm a guy who has some access to capital, but it's not indefinite. Okay, so let's say if I compete for a single unit, most likely everybody can compete with me for a deal. At the time, we're talking about units that cost between $50,000 to $80,000. I remember my cheapest REO that I bought in Kissimmee, I think was like $27,000. Okay, probably today it sells for 200, but those were the times, my friend. But basically, so for the single units at some price, let's say, and maybe today it's about 100,000 or to 500,000, an individual person can say, okay, I'm willing to risk, this chunk of money. Okay. But if you go to deals a little bit bigger, let's say between 2 million to 5 million, then suddenly you're talking about deals that are not easily accessible for an individual person. He has to be quite rich person to be able to risk his $3-4 million. On the other hand, the big guys that have funds of 100, 200, or $1 billion don't touch those deals. So it's a market which is under the radar of the big institutional guys, but it's probably beyond the reach of the individual investors, who, let's say, retail investors. Okay, so I thought that this is probably the best niche market that I can excel. And I did, by the way, okay, because I was able to create a business where I raised my capital from people. And at the beginning, it was a little bit challenging, but then, suddenly I had $4 million in GC1. But with $4 million and I started buying, then I came to you and you said, oh, Jerry is a serious investor because he already bought with me a few deals and he has proof of funds for $1 million or $2 million. And suddenly it's not easy to compete with me unless you have this capital raised behind you, okay? And at the same time, the big guys who at the time were going maybe to the Cushman and Wakefields and the CBREs, they were looking for deals of equity of 20 million at least, and they didn't look at the deals that I was looking for. So it was a quite interesting market for me to be in, where the competition was relatively thin, and I think I was able to get very good prices.
Yes, it was very successful. Would you like to share your slides that you put together?
Sure, yes. Why not? This is it. Yeah, you see now, you see something? Yeah. Okay, so basically, as actually I told you a little bit before it, at one day about 2017, a professor friend of mine who was teaching MBA for real estate had a course where he invited every class, he invited a different professional of real estate investing to talk about his experience. Okay, and obviously he invited the CEO of like a S&P 500 company, and then he invited the CEO of the REIT, and then he invited Jerry Mandel, who created and funded a few real estate investing funds. And a lot of the students were actually mostly excited from what I had to talk, okay? And I will share with you a little bit later in this presentation 2 slides that were the focus on my lecture to those students. And from their interest and enthusiasm, I decided to turn it into a book and to the guide that I wrote, okay? The complete guide to real estate investing and sponsorship. Basically, it's to give the person who is already investing in real estate or wants to start investing in real estate a thought to think a little bit bigger. It's possible. Turn it into a business. Turn it into a place where you can actually target bigger deals, maybe attract some capital from friends, initially from friends and family. Later, a friend will bring another friend because they will hear, oh, this guy, Jerry, is doing a great job. I'm making nice returns of 12% IRR with limited risk because, I was very low leverage or sometimes even zero leverage. But, why not? And I was able to create nice things. This is a little bit about me. Basically, I was an investment banker with Merrill Lynch. It's an old Wall Street company that today is a subsidiary of Bank of America. I worked for them for 10 years between 92 until 2003. And I actually, in 2008 and 2009, in the middle of the subprime crisis, I realized that this is the first time that I'm actually pretty much free to think and take advantage of global market things that are happening at the time. Because when I was working full-time for the bank, I actually was focused on my business, on my job, and not on doing things outside of the job. But here I found myself first time actually not working, and I said, wow, this is a crisis that we should take advantage of it. And I decided to start a small real estate investment fund in Florida. And overall, this is actually what I did. So in 2009, in September, I established my first fund, GC Residential Properties. Basically, when I started talking to friends at that time, I never did a real estate investment deal in my life before. Okay. But I did have a good reputation of people who know me because I did my MBA and I worked for Merrill Lynch. Some people knew me, respected me, and they were willing to risk some money with me. But I was able to raise $1 million and start the business of GC Residential Properties, which later I nicknamed it as GC1 because I raised GC2, GC3, GC4, and GC5. Okay, but overall, I established this business as a sponsorship business, basically structuring it as a private equity fund, which a private equity fund can be a fund of $1 billion and can be a fund of $1 million or even $100,000. Okay, the structure is the same. Obviously, you need to manage your costs, but the advantages of it is that it allows you the flexibility to grow your business in case it grows and you have the opportunity. So I started, my first closing was a $1 million fund, but overall, I think there was an investment period of 6 months. It grew to 4 million because I was able to tell people, listen, with 1 million, I already bought this, I guess, 20 units in South Florida, condos. You know, the price 2 years ago was actually 3 times more. Now I'm buying it at 70% discount to last price, and people gave me more money. Still, you know, in the middle of 2008, 2009, cash was a very scarce resource. So it wasn't easy to raise money, okay? Other times, probably it's much easier. When I finished investing in GC1, I talked to my investors and some other people came in and I raised another $5.5 million of equity. That was in 2010, a year later. Then I finished investing that $5.5 million and I raised GC3, which was already in 2013. So it was like 2 years and a little bit later, $8 million of equities. And then GC4, I raised 6.6 million. But at the time that I started investing, by 2015, I decided that I'm actually starting my fund in Spain. So I ended up investing only 3.9 million of equity of this fund. And in GC5, it was actually an opportunity, and this is a quite interesting story, that in one of my by the way, did you send me to Cocoa? I think it was you, no? To buy those duplexes?
Yeah, to buy the duplexes. Yes, correct.
So it was it was a great deal, my friend. But anyway, I think there was like 6 duplexes. Then I ended up buying like 10 of them. But when I was driving to Cocoa, I remembered that a broker in South Florida told me like 3 months before that there is a mini self-storage for sale in Cocoa. So I said, wow, I'm already driving these 2 hours. Why not I stop by the mini self-storage and look at it? So I called the broker. She told me, no, I think it's sold because it was 2 months before. And I said, listen, do me a favor. I'm already driving anyway. Just call the bank, check if it's available. If it's available, let me know because I'm going to stop and then I take a look. And basically, she called me 10 minutes later and said, by the way, it's still available. So on the way to Cocoa, I stopped at the mini self-storage. I went in. I talked to the manager. He did me a small round. I decided that, wow, this is a very good investment opportunity. And I decided that I will look into it and obviously ended up doing the deal. The interesting thing about it is that my investors from the residential funds, which was GC1, GC2, GC3, GC4, which are purely residential, at that time told me, Jerry, why are you going to do something which you have no experience in, mini self-storage, okay? We don't want to invest in mini self-storage in GC4. So you have to do, or GC3 it was. So I had to do a standalone fund specifically for the mini self-storage business, and I called it GC5. And it was probably one of my most successful investments in Florida, okay? And why it was the most successful investment is because I negotiate with the bank. The bank was the property owner, and I said my condition to buy it is if the bank will lend me 50% of the purchase price, which was at the time not so easy to achieve, but it did, and it was my only leverage deal in Florida out of all of these things. Okay, in the other ones, basically it was 100% equity investments, and perhaps later I used to take some financing from some of my investors. So as you can see, basically the funds are, I call them boutique size, okay? I act like an institution because I make good reports. My investors feel very comfortable because they have a lot of transparency to the business. They get reports probably at the highest quality available, but at the same time, you know, some investors are bigger, but some investors were friends and family. Maybe they invested $100,000 or $200,000, okay? And you have a mix of investments. If we go to the next slide, basically, and this is one of the things that I thought for myself, but I told the students at my lectures, you know, you're already interested in real estate investing, you're doing it for yourself. Why don't you become a real estate investment sponsor? Okay, turn into your passion or your interest or your search for passive income into a bigger passive income opportunity where you can do bigger deals and actually perhaps charge fees for that, etc. So the benefits of doing this is basically at the end of the day, when you do, let's say you buy a single family home and you buy it and you do your due diligence, okay, it's probably not much different than the due diligence that you will do when you buy a 30-unit multifamily, and probably not that different if you buy a 150-unit multifamily, okay? At the end, you have to go through the legalities, you have to do the technical analysis, etc. Yes, it will be a little bit more work, but it's not going to be 30 times more work, okay? Probably it will be maybe 1.5 times more or twice, but not 30 times. And here you're doing a deal 30 times bigger and with much higher potential for making money for your investors, for yourself. And with the same amount of work in terms of doing your due diligence, structuring, and some of the fees will be fixed anyway, and you can spread it into a much larger deal. So basically, and when you have your more money, you can talk to a lot of brokers, you can see deal flow, you can do bigger deals, you can apply more money. And if you have the capital, you can access probably more profitable deals. Okay, and as I mentioned before, if you look for the niche market where you have your competitive advantage, that's the niche that you should pursue, and you will find a lot of deals. One of the things that I said, and I'm sure that you know, we talked about it many times when we did the deals, is cash is king. I used to come to people and say, listen, I don't mind putting the 10% escrow deposit. You want 20%? No problem. Okay, but I want a 5% price discount on the deal because I had the money already available, and why not do a bigger deal? Okay. The second thing is, if you do your own deal, you're buying a property. Maybe you do the next deal, you have 2 properties. But if you do a pool of capital from investors, you are able to do multiple properties, and suddenly you have a risk diversification of a portfolio. Okay. And one thing that I tell people when they ask me, you know, sorry, why they ask me, listen, I have money, I know this person in Florida. Why shouldn't I buy this property on my own? You know, it's a nice condo. I can rent it. I know this guy is going to manage it for me. Or I can take the same, let's say $200,000 and invest it with you. So tell me, what are the advantages or disadvantages? And I say, listen, let's say I buy a multifamily of 200 units and you buy a single condo, okay? Now, let's say in your single condo, suddenly your tenant stops paying and the air condition breaks apart. It could happen, it's bad luck, okay? Then you have 100% of the problems in your own property. But if I have a 200 unit multifamily and I have 5 people that don't pay rents, I still have 195 people who pay rent. If I have 10 units with broken air condition, I still have 190. So actually these costs are spread over a larger number of units, and you probably don't even feel it, okay? So the downside is that if he invests with me at the end, he will have to share some of the fees that I charge, including performance fees. But on the other hand, he gets exposure to a more diversified portfolio, less individual risk, and probably he will do as good as a financial investment as he would have done probably if he did it on his own, okay? The next thing is fee optimization. That's something that I think, wow, if you're doing your investments up on your own, it's your own capital, you invested $200,000, maybe you're making 12% IRR. So at the end, after 5 years, you sold it for 150%, so you made 50%. Okay, but if you raise those $2 million and you did 10 of these deals and you invested still your $100,000, but now you're making not only a fee or a success of your own investment, but you're making 20% of the upside of the other $900,000 or 2 million, then you actually worked almost the same amount of efforts for the next 2-3 years, and you made probably 6 or 7 times more fees just because you were able to do more deals, bigger deals, and with sharing some of the performance fees from your investors. Access to better financing is also an important thing, because if you can negotiate with the bank on a bigger deal, if you can save 0.5% on the interest rate, it turns into upside, and it's a lot of money for your investors. And then scalability. Every deal that you do, you have your fixed costs, and suddenly you can share it instead of on one unit, you can share it to over 100 units or whatever. And the last thing is, I think it's really the summary of all of these things. At the end of the day, and this is what happened to me. I wanted to buy a few properties in Florida, and I said, wow, it's gonna be too tough for me to invest my 200,000. I want to raise 1 million, and suddenly it became my second career, and it's a good business. I have a good relationship with investors. I made them very happy because they made a lot of money with me. But at the same time, this is a business for me as well, and I make money, they make money. It's a win-win situation. So being a real estate investment sponsor, it's an opportunity for you to actually take advantage of your already efforts that you're making in a deal, and just doing it for other people who don't have the time to do it because they are full-time jobs or they don't have the expertise, etc. And this is basically the tips that I gave to the students in my lecture that I told you about. Basically, I explained to them 2 slides, and after that lecture, I decided to turn it into a book, which is a complete guide to the real estate investing and sponsorship. So first of all, this slide is pretty much a snapshot of every real estate investment that you will do, okay? The sponsor in the middle is you. You can be an investor, but you can be also a sponsor. Okay, sponsor is an investor, but who's doing not only his own work, but also is working for other investors in the same pool. Basically, on the right side, and I look at it as let's say as a formula. When you have an algebra formula, you have a lot of unknowns, okay? But in real estate, basically you have 2 major unknowns. One unknown is where you want to invest your money. So what is the property? I'll talk about it in a second. The other unknown is how do I fund it? Where do I get the money from? And basically, if you look at the top right side here, the property, when you find the property, you're dealing with specific attributes of a property that you're looking at, and you have to understand who is the seller. Okay, seller and property, probably you need to negotiate a thing. The lender, especially if you're talking about a non-recourse loan, which obviously our goal is to borrow non-recourse, so to not have unlimited risk exposure. for this investment. But if it's a non-recourse loan, it's very, very dependent on the quality of the property. Obviously, the property, the tenant. So I marked it in a circle because the property and the seller and the lender represent one side of the equation, which is what you're going to invest in, okay? And although the lender is part of your capital, but it's linked much more directly to the property than to you because it's a non-recourse loan. On the other side is where are you going to get your money from? So if you're bringing your own money, then forget about it because it's your own money. You will decide you want to do it with your fund, with your investment company, with your own money. You want to put it on your name, on a company name, on an LLC. You decide. But I'm talking about a sponsor. You know, a sponsor is somebody who is going to take advantage of larger deals, multiple deals. You probably want to create a business out of it. So the two important things is who are going to be your investors because you want to raise capital from them, and what is the legal structure that you're going to use that will be able to help you well in your business, but at the same time be acceptable to your investor as a formula to invest with you, okay? So what I decided is listen, I'm using the structure that all institutional funds use. If you're a KKR, if you're a Blackstone, you will use a private equity fund structure. Okay, in the US, you can do it through an LLC, but at the end of the day, it is very well-known standard way, and it allows you to raise $1 million or $10 billion, okay? So obviously, the investment vehicle and also it implies the tax structure is very important, and this is key to raising your capital and attracting capital from investors. So basically, these things, and when we go to the next slide, this is actually, you know, if I talk about this is my book. Is talking about the various aspects of the deal that we discussed in the previous page, but now giving the key players, the sponsor, the lawyer, the accountant, the tax advisor, the property manager, the realtor, the architect if you want to build something, your investors and the lenders, and then see each of these people, and those are the main people that you will deal with, each of them will have a different interaction with you throughout the life of your business, okay? And I divided it into 3 phases, phase 1, phase 2, and phase 3. Phase 1 is the phase where you set up the business. You decide, okay, what am I going to do? So if you are the sponsor, you need to determine what is the business opportunity? What is my investment strategy, okay? What investment vehicle am I going to use? What are my investment objectives? And then think about what will be the fees and terms that I want to raise, that I want to charge for my investors, and how am I going to do the capital raising. If you are the lawyer, so I'm going to talk to you about what will be the legal structure. Is it going to be a REIT? If you're like Blackstone, maybe you want to do a REIT. You don't do a private equity because you want it to be publicly traded. But if you are a Jerry Mandel or somebody else who says, okay, I want to do it as a small business, as a boutique, maybe an LLC with a limited, like a private equity fund structure is what works for you. Okay, this is what I decided to do. In Spain, as I mentioned before, I decided the most tax efficient way was to do a REIT actually. So even though I'm a small REIT, I am a REIT. And at some point, I think I was like the number 15 top homeowner in Spain, although I was quite small at the time, but there weren't so many players. The next person is accounting, okay? So I need to decide how am I going to look with my new business? Are you doing a deal by deal basis or doing it like a pool? It will affect your accounting, your financial statements. Tax advisor needs to tell you about what will be your investment vehicle. Do you have purchase taxes in Florida? You don't have purchase tax. In Spain, you do. So if you are a REIT in Spain, you don't pay purchase taxes or you pay discounted purchase tax. Corporate tax, and what will be the tax implications to your investors? So is it going to be an LLC, so it's transparent to your investor, or is it going to be a corporate where you need to pay dividends? You need to think about it, because at the end of the day, people will say, okay, I'm giving Jerry my $500,000. I want to make a return, but I also want to make it the most tax efficient, okay? If at the end of the day, I'm doing well, but he needs to pay 50% taxes, then probably somebody else who makes less return, but a lower tax rate, it gives him a better return. And then, the next one in the setup phase, obviously, and one of the most important key people will be the investors. Who are the investors? How do you attract them? And then you need to show them the investment vehicle and what will be the fees and the terms. Is it a 5-year fund, 1+1? We can talk about it, but basically my book goes into the details of each one of the things that I just spoke to in phase 1 and in phase 2 and in phase 3. In phase 2, for example, this is already the investment management phase, where you already set up the business, it's structured, you raise the capital. By the way, a lot of people, and I did capital calls. So you don't call the money 100% on day one, but you call it as you grow your business, you find a new deal, you make the first investments, you call some more money. At the end, you call all of it, yeah. But then you start the deal sourcing, deal structure, due diligence, financing. What will be your value creation strategy? You have to think about it on day one. Asset management, cash management, financial projections. A lot of people will say, okay, I'm giving you my money. What is your business model? How much should I expect to receive? You have to already think about it and build your business model to be able to tell people this is my expectation, okay? Legal due diligence, and on the one hand when you do deals, but evictions on the other side when you have tenants that don't pay. Evictions, by the way, is probably one of the things that will affect, in my mind, your decision to invest in a single property or to invest with me and be exposed to a pool of properties. Because if you have eviction on your own unit, it's 100% bad. But if you have an eviction in a portfolio or multifamily, okay, it's bad, but it probably doesn't affect the numbers so much. And I can tell you from my experience, and I think in Florida, I think at the end or cumulatively, probably I owned about or more than 500 units altogether, okay? And I shared all of the experience that you can imagine. Paying tenants, not paying tenants, evictions, people who disappear one day, whatever. And so every single experience that you can imagine, I had it in my portfolio, but still, because it was a portfolio, it didn't really, yes, it affected maybe 1 or 2% on the performance of the company. I mean, out of the 100%, but it didn't affect that much. So maybe instead of making a return of 12% IRR, we made 11.5%, okay? But if you have these experiences on your single investment, suddenly you're not only not making 12%, you're probably making or maybe even losing money, okay? And again, tax advice, how you're going to structure your investment, how you're going to structure your exit. You have corporate taxes, you don't have VATs, etc. I think taxes are an important aspect of how you structure your business, because at the end of the day, it's money that you have to pay. And if you're able to structure it in a way that your investors can get it with taking advantage of their own lower tax rates, it's better. They will be more willing to invest with you. And then property managers in this stage are probably the key. And obviously, when I started in Florida, I made a point that I had 2 property managers in south of Florida, and then 2 property managers in central Florida. And then obviously, if one was better than the other one, I gave him more business, etc. But those are key, the ability to work with them closely. I'm a hands-on person, but at all times, I follow this rule, but I told all of my friends that they have to have a professional property manager on the ground to do it professionally. And also If you want to sell it, if it's managed by a property manager, a professional property manager, it's easier to sell because then it's a decision of your buyer if he wants to do it himself or continue their relationship with your existing manager. But it's an easier sell. And then obviously network of realtors that give you the deals, like working with you and I like working with them. But this is a deal source and they sometimes help you do the leasing or lease renewals. Sometimes it's the same person as the property manager, but they also play a critical role. Due diligence, I wrote architect, but sometimes you have other people that will do some technical due diligence to see if the structure is good, bad, etc. Both in the due diligence process, but also if you need to do some improvements, if you want to build something, a lot of maintenance, repairs, etc. In Florida, by the way, at that time, I didn't do much building, but I did a lot of repairs and maintenance when needed. Sometimes I bought the units that were in need of major repairs, no, to turn it into a place where you can actually list it and have people living in it. And then investors at that time, and by the way, my structures so far is with limited investors. Those are my investors and the general investor or general partner or the sponsor, which is me. So basically, I am the decision maker. My limited investors, they have also a limited ability to influence on the business. Obviously, if they are big investors, you want to talk to them and keep them happy. But at the end of the day, they don't want to do it themselves. They want to rely on you and they want limited exposure also to the financial risk of the investments. So they are limited, okay? But they do expect to receive from you quarterly reports or update reports from time to time. Obviously, any major acquisition or any major sale of any property, you want to tell them. Obviously, if you distribute cash, it's a good thing. But the minimum in my thing was quarterly financials that I distributed. And then lenders, they are key at the beginning. And as long as you pay them on time, I think they're very passive partners of yours, okay? So you have to be able to structure the deal in a way that you match your cash flows from the business to the financing requirements of your loan. Very important. And then remember, I think we just talked about it before, if you have any resets or adjustments on the way, you have to make sure that your business can support it because it could be a surprise, sometimes a bad surprise. And one of the key things in real estate, in my mind, is that you don't want to enter into any situation of fire sale or the need to fire sale because that's when you lose money. And I was in the times of the crisis in 2009, 2010. I also was in the COVID period. Okay, that was in Spain already. So those are sometimes you feel you go through difficult times, but you have to have a business model that is sustainable and can support downtimes and not get into a situations where sometimes you need to bring more equity capital and sometimes you need to do a fire sale. Neither is too good because if you need to urgently bring equity capital, your investors will say, something is wrong with this investment. Not always they want to add more capital. So you have in advance to think about it. I sometimes raise more equity capital than I actually need to allow myself a little bit of a cushion. And it could be 10% more or 15% more, just so I have cash at all times. And I know, okay, I am going to affect a little bit negatively my investment returns, but I will sleep well at night. My banks, my lender will always be happy because he knows that I have cash to support the next 3-4 months of interest and principal payments. And this is something that I try to do in all my businesses. And then basically, when you finish phase 2, or it could be on a deal by deal basis, but you feel that a specific property, you finish already all of the potential property price value appreciation strategies that you thought about, it's time for you to start thinking about selling it. And many times you have to start thinking about, okay, what is your exit strategy? Who are you going to sell it to? How are you going to position it so it will be attractive for those people? And sometimes as a sponsor, when you sell a property, you obviously make cash distributions, but sometimes you don't sell a property, but you have cash from rental operations, and you do also some cash distributions. And then tax is also important. How do you distribute? Do you distribute it as dividends or as a return of investment? Do you have withholding taxes? You have to make sure that you're complying with all of the tax requirements in every jurisdiction that you work with. Okay, so you don't want to get into trouble, and you want your investors to know that you are acting always legally with very good advice, and your advisors are from the top tier. And then realtors, by the way, key players in this thing. Many times the broker or the realtor who brought me the deal, he's the guy who is going to help me sell the deal, but obviously he now knows the property. He's close to me, and he's close to the property. He also knows what are the improvements that I did, and then it's the time to sell. And then investors, this is the time that they are happy. Suddenly they say, wow, I invested with Jerry 3, 4 years ago. I put a $500,000. Now I'm getting 750,000. Amazing. Okay. And they asked me, when is your next investment going to take place? So basically, this is in a snapshot of what are the key roles and activities each phase of the sponsorship business and each of the key players. And every single activity here is actually described in the book. The book is like its name. It's a guide. It's from A to Z. If you want to do a sponsorship business, what are the things that you should think about, consider, who you should consult, what are the type of strategies, the type of structures, the type of properties, and what are the things that you should look into it. It also has a chapter about some of the deals that I did in Florida. I do talk about my first fund, GC1, because I thought it's very interesting to see how I actually created my first fund out of without any experience in real estate. Okay, how I started with $1 million of capital committed, and now I actually shared a few of the slides that I used it with with the investors that I try to target, and some of them invested with me. And then there's a couple of other deals. I think one of them is El Camino. I think that you and I did together. You showed it to me. It's an amazing deal that I always talk about. I actually bought it as a second. I wasn't the first one from the bank. I was already the second, okay? Because another guy bought it 2 years before me from the bank. He bought it much cheaper than me, and then he sold it to me. But at that time, I still thought that there's a nice upside going on. And I thought about it because I thought that he didn't do a very good job in managing it. So I'm talking about that case study as well. And then I'm talking about the mini self-storage, also about how I came to do that deal. So I think overall, basically I had a very good experience, hands-on experience, as opposed to a lot of the big fund managers. I like to get my hands dirty in the job, knowing the ins and outs of every property that I buy, get into the details of the property managers, how they want to do, what is the leasing strategy, etc., pricing, who is our target markets, and then and all I wrote it in the book. And obviously the book I'm very proud of it. It was also translated to Spanish, as it's a market that I work on now, and it's both of them, the English version and the Spanish version, are available on Amazon, Amazon.com.
Jerry, thanks so much for sharing all your knowledge. I know it was great working with you over many years here in Florida, and I'm excited to hear about all your successes in Spain, doing a similar business model there. Really appreciate you coming on and sharing all your knowledge. What's the best? Is it better for people to reach out to you via email, your website? What's the best way for people who want to find you?
Yeah, I think both email, my website, I have two, one in Spain, one in Israel. www.galilcapital.com is directly to me. .es, which is España, Spain, is going through my read, but both have my contact details and my email address, and I will get it. Happy to answer any questions that people may have. And really, it was a pleasure being here, Joe, and really good to see you. And I'm sure that at some point I will come back to Orlando. It looks like a great market to do more deals there.
Yeah, we're looking forward to seeing you again. Awesome. Thanks, Jerry.
Thank you very much. Talk to you later, Joe. Bye.